Today, a collection of property experts say Hi again, it's Martin North from Digital Finance Analytics, where I've noticed post covering finance and property news with a distinctively Australian flavour. Well, today we have no less than Edwin Almeida and Louis Christopher with us. Hi, folks.
Hey.
Well, all I want to say, Martin, is happy Valentine's Day for tomorrow.
What? Hey, no, it's great.
You too, Louis. You too. Yeah, but look, the other thing I want to say is we are going to let our hair down, right? Except you, Louis, you can put it on.
Oh, that's a little bit close to the bone.
Everyone loves doing these things, but sometimes he needs to look in the mirror himself.
Absolutely. But look, this is a really important conversation, right? Because we are in the middle of a really interesting change in the way the property market's going. And with Edwin's, experience there at the front end, yours, Louis, in terms of all the data that you share and the perspectives you have and my surveys, we're actually quite uniquely placed, I think, to have a little bit of a discussion about what's really going on. Because what's really going on and what is presented as in the media as going on is, to me, a really important question.
Yes, agreed. We have different perspectives, and yes, obviously I come from more the data side, the housing statistics side, and that enables us to get a sort of a pretty sort of top-down view on the market. However, we all know that there are limitations with the data, and so it's also important to get an on-the-ground view just as much as understanding what's going on from the top down. It's the thing is with the housing market, it's always been the case and always will be. It is nothing like the stock market, where you've got standardized listings where we can see at any point in time how the market is trading. With housing, fundamentally every property is unique. A property on 22 Smith Street, a semi versus a semi on 20 Smith Street, right next to each other, I can assure you will still see differences, and there'll be justification for the differences in sale price between the two. And that's what makes housing ultimately very challenging to measure, but nevertheless we can, to a degree, measure it reasonably well. And unfortunately, what it also enables is, the word of the decade, misinformation. And we all know, all three of us are well aware. We've all personally seen misinformation out there on the housing market. So this is why you can see things within the media where literally on the same day you can see a story which says the housing market is rising or getting stronger and the housing market is weakening. I've even seen that from the same masthead at times. So yeah, it's definitely a fascinating part of the economy. As we all know too, it's a significant contributor to the economy, hence the reason why there's a lot of focus on it.
I guess from Martin, from my side, you've got what we see is the political agendas that you and I often talk about, and how what politics, what role it plays in the housing. The other one is, of course, the characters that are at play. One of the main actors, or the main actors that we discuss about, is both the selling agents and the auctioneers. What story do they tell their clients? Because at the end of the day, it's self-interest, it's self-gain, and I guess from both the politicians and the actors at play on the field, is really comes down to self-interest, and how much more of a self-interest does the outcome is. The outcome determined by how much information they want to peddle in their favour to line their pockets, and and hence the reason why we've got a lot of misinformation. And then you've got the main data, or so-called main data sources that really is very much lagging. Whereas when you look at Louis' data, it's one of it's up there. It's there's a bit of a delay, but not as much or a greater delay as the other data houses that are bringing out information. So I guess you could you would say that would be a fair call, wouldn't you, Lou, as well?
Yeah. It's this is the problem with timely data. Is the more timely you get, the less sample data you've got to play with. And so you can see distortions that happen. And I think one thing you'll see from us is one thing we generally avoid in the media is that we don't tend to run like what are the top performing suburbs for the last 12 months. Because you'll see some of these stories, they report suburbs jumping up 50% or down 20, 30% or more. And the problem is that you often find when you dig deep into that particular suburb, it's just simply a whole bunch of lower quality properties selling in one period versus the next period where a whole bunch of high quality properties have sold, and it creates this distortion. So look, timeliness is definitely a challenging thing with the housing market. There's no question about it. We do have some good indexes out there, we believe, which try to reduce that timing gap. As you know, we like looking at asking prices, which help us do that. We like to look at weekly rental listings as well. And then, of course, the auction clearance rates, while, of course, they only represent a certain smaller percentage of the market, smaller than what I think people are aware of, they have proven in the past to be able to pick turning points in the housing market. And so, they come out each week. And as you know, we put these out on Tuesday as opposed to the very Saturday, because we're very keen to ensure that we're reporting on all the auctions which have occurred, not just a glossy sample of them.
Glossy sample. Indeed, that's a very good way of putting it. Well, I tell you what, look, it'd be rather interesting if you just step through those sort of 2 or 3 critical data points, the auctions clearance perhaps, and some of the other stuff you're looking at, because I think a lot of people won't actually necessarily understand just how current the data is that you actually are able to produce.
So what I'm sharing here is the results for the week ending the 5th of February. Okay, so we're on the 13th and we're about to report tomorrow, being Tuesday, the results for the preceding week. And what we recorded for the week of February was a Sydney clearance rate combined for the full week of 52.6%, with the splits being about 46% for the midweek, 54% for the Saturday. So people should just be aware too that what we do in terms of our how we calculate our clearance rates, which is a little bit different from our peers, is that we wait until the advertising, all the ads have been adjusted to reflect what happened on the day for the auction. So whenever an auction is on, it will be advertised online, as we know. Then after the auction, shortly after the auction, the agent will do either 2 things. Firstly, they will make a note that the property sold and give the date of sale, or they will put up new open for inspection times on the property, or they will completely withdraw the advertisement altogether, which indicates that maybe the property's been completely withdrawn. So we capture all that, and that enables us then to go beyond just a sample of the auctions, which you see in these preliminary results released on Saturday night. Now, by way of background, I used to run an auctions team at Australian Property Monitors in a previous life. That was from 2000 to 2006. And we've spoken about this in the past. And back then, the requirement was very strict. We had to get 90% of the auctions on the day. So I had a pretty large team doing that. That was a contractual obligation we had with Fairfax at the time, 90% on the day. And if you are aware of the domain auctions nowadays and others, you can see they never get to 90% on the day, not even close. So this is where distortions start occurring, because agents will tend to want to sort of tell the groups such as Domain, CoreLogic, their successes, but generally steer away a little bit from reporting on their failures. And that's why you see week after week these auctions auction clearance rates from my peers being regularly revised down. I don't recall actually a weekend, maybe you guys have, I don't recall a weekend where they were revised up. Do you?
No, not at all.
Anyway, no, so it doesn't happen. Anyway, let's talk about, well, what are we seeing in the Sydney market? We can jump to Melbourne because these are the two big auction markets. And so here's our chart on the clearance rates. You can see that, firstly, let's consider 2020. So just prior to COVID, on our numbers, the auction clearance rates in Sydney were coming in at 66 to 69%, which was a relatively strong market. So just prior to COVID, the market in Sydney was actually running quite strong. We had the easing of financial regulations in 2019, the surprise win of the Liberal Party of the election of that year, and we saw a market actually start to recover across the country. Then we had a literal collapse in the auction clearance rate as COVID broke out. But thereafter, through all the government stimulus, the rate cuts, we had this constant recovery in the clearance rate, where we saw clearance rates getting back up to 60%. And as I'm sure you would agree, the second half of 2020, the housing market in Sydney was actually quite strong. Then in 2021, we had a pretty interesting year. The market really opened up quite strong, where we're getting clearance rates in the 70% range, which was some of the strongest results we've actually recorded. We, of course, had yet another lockdown over this period here, and the clearance rate fell away, but shortly thereafter, it recovered again. And then we had this period in late 2021 where the clearance rate fell away and away and away as volumes started to really rise. They really started to ramp up. And certainly in that last quarter of 2021, volumes were extraordinarily strong, and it was a great time really to be a real estate agent in Sydney. And then in 2022, market opened up strong this time last year. We're getting 60s, not as strong as the previous year essentially, but it was still relatively strong, but not as strong. And this is the thing you will find is that each and every year, the market generally opens up on a stronger clearance rate than where it finished off in December. And that's the seasonality that we get. They don't call it the spring selling season for no reason. It's because you generally find at each spring period, you get a rise in volumes. But in last year, what did we have? Well, the moment it did open up, we had the clearance rates fall off again, and that was going into March and April. And I believe that period of time was a time when the market was increasingly expecting the RBA to lift rates, even though they said they wouldn't, but they were expecting it. But on top of that, we had in the December quarter movement by APRA on their serviceability buffers, and that was about trying to sort of slow down lending, and I think that did work. And then, of course, we had the interest rate rises starting from May, and we had further falls in the clearance rates down to where we're getting clearance rates in the 40% mark in Sydney, which indicated housing prices were falling, and as we know, they were indeed falling. We had a little bit of a pickup in the September quarter, which was interesting. I think there was an expectation in the market that the RBA would go on hold soon, but we know they didn't. And then at the very end of the year, big falls in clearance rates. This period here, yes, we've got it mapped out, but there was no volume. That's the January Christmas holiday period, hardly anything there. We'll still map it, but we don't read too much into it. And now with the market opening up again, once again, we've had that boost in the clearance rate from December, but it's coming lower than what we actually had this time last year. And it's hovering at the moment around the 50 percentile mark. And my expectation is that we'll see this number roughly around the 50 percentile mark for the next few weeks, and it could very well fall away again. Probably fair to say that what we're seeing here is clearance rates in Sydney, which would not suggest an outright housing market crash, but a market which is certainly in the doldrums, is weak, arguably fairly orderly in terms of the downturn so far. I haven't really seen on the numbers anyway any great panic. And we can talk about the lack of listings very shortly as to one of the reasons why. but yeah, the clearance rates, yeah, definitely have been stronger. If we had a further back series, keep in mind we only started this series back in 2020. I'm sure it would have shown that, for example, in 2012 and 2008, we probably would have recorded lower auction clearance rates at that point in time. When I was running APM, we had clearance rates back to the late 80s, and I can tell you now they were very accurate. And the lowest clearance rate I ever saw for Sydney over that time was actually mid-1990, when the clearance rate in Sydney hit 33%, and that's when the cash rate was getting up to about 17%. Hopefully that explains a few things certainly from our perspective.
Well, very, very interesting, and I think it certainly resonates with what I'm seeing in my surveys. Edwin, does that chime with what you've seen as well?
Yeah, look, it does, and it also comes back. We also need to, although we're going to be talking about a bit later on with regards to the low list, for sale listings on market, and that has played a big part over the last few years, and in terms of clearance rates. Now, also the appetite or the desire for people to go on market by way of underquoting. Sorry, I mean by way of auctions. So it's because the agents need to secure a sale. They don't want this. They don't want the sale to drag on because they need the cash, because they are cash strapped, right? So because that's the general consensus across many industries. It's a cash strapped economy. So and there's a push. Now the other thing that we've seen over the last 18 months that you and I have been talking about, Martin, is the fact that a lot of agencies are pushing their vendors into an auction campaign. Hence the reason why we've seen a growth in sale by auction, according to the seasons throughout the year, depending on the seasons throughout the year, is because the agents have convinced the vendors that it will secure a sale. If somebody commits, they're locked in with a 10%, as opposed to locking them in with only a 0.25%, and therefore you've got a cooling off period and they can walk away. It's easier to walk away from a 0.25% when the valuation doesn't come in than it is to walk away from a 10% when the valuation doesn't come in. So there's that big driver. Hence, I said earlier on that one of the biggest motivators of this, what we're seeing now, is the actors at play. The main actors being the selling agents, that they need a sale, not because they want to achieve the best outcome for their clients, but because they want to secure their commission. And hence the reason why we see this rising in numbers in a period where, in my opinion, a much better way of negotiating would be via private treaty to obtain the best result for their vendor. But that's not their interest. Their interest is to obtain the best outcome for themselves, right?
And they can get a bit of extra money on the way through, right? Because they can charge for the campaign.
Of course, they've got the campaign, they've got the marketing campaign, the whole thing. So it's, I think, what we're going to see moving forward. There's enthusiasm, no doubt, especially over the last 3 weeks. From what we've seen, where we've seen anywhere between 14 people turning up for a 2-bedroom apartment, open house in the inner west that was built in 1968, and it looks like crap, to 170 people turning up to a 3-bedroom house in Seven Hills and get sold on the day. I mean, it's because there isn't really enough properties for sale on market, and there's huge demand. So then you've got obviously the other actors in this current period is the government and their vested interests outside of political. There's also the agenda that you and I talk about, Martin, regularly, and that hands up all the politicians that don't have an investment property. Crickets.
Not many of those. Exactly. But you make an interesting point about listings, and Lou, I'd like to get your input on the listing story, right? Because we are seeing some quite interesting dynamics going on there, and they're a bit unusual, I think.
Yeah, they are. I think with the listings market, yes, so far it's definitely clear for all to see that there's been no grand rush by property owners to list their property in this current downturn. I guess we shouldn't be greatly surprised by that. Vendors love to sell trying to sell at the top of the market, and they're loath to sell when the market is falling. And if they can hold out, then generally they won't sell unless they're buying back into the same market, or they're feeling particularly negative about the outlook on the housing market. So far, listings in this downturn have been sort of fairly quiet, and this goes to one of Edwin's points about, look, hey, it's pretty tough. For many agents right now, they're fairly cash strapped, and I would have to agree with that based on agents I've spoken with, that, look, okay, they're suffering from two things right now. They're suffering from relatively low new listings, and they live on new listings. That's their pipeline. But at the same time, their sales volumes on those listings isn't exactly that high. So yeah, their commissions have been absolutely smashed. Not that we around here are particularly bleeding for them, but that is the reality right now for the industry. Is that it's a very tough industry at this point in time, and I've no doubt there would be agents who are probably getting to the point where they have to leave to find some other work. Edwin, would you agree with that?
Oh, look, yeah, I've been posting on Twitter, and Martin and I have been talking about for a few months now how a lot of the people that we talk to, I would dare say anywhere between 20 and 30% of the agents that we talk to, they've got a second gig. They're either driving an Uber or cleaning at night time, doing something outside, because they've also got mortgages, they've also got leases. And this
they've also got shiny new cars.
Yeah, they've also got shiny new cars, and they've also got suits that they have to get dry cleaned. Yeah, and so all that plays a big part. Louis, I believe that we're back to where the real estate agents were in 2019. At the tail end of 2019, yes, it was great for property prices as they were rising towards the end of 2019. But if you recall, the volumes of sales weren't there, and the industry was on its knees. I know a lot of agencies, not just agents, but a lot of agencies that were on their second and third credit card, as Martin and I have discussed in the past, that you have to pay off debts. So you've got the similar situation now, where one of my predictions is that 20 to 30% of real estate agents will leave the industry this year, and because we're back to 2019, the volumes aren't there. And as you said, Louis, although you could say that if a person was to sell a home now, that would achieve a great outcome, because there's not much on market, particularly if it's something that's desirable to a small family, right? But where do they go? Now, again, this is another topic that you and I have discussed, Martin, and that is for the retirees and the empty nesters that want to move on, that want to sell, they can't maintain the upkeep of the massive homes, whether it be in the Shire, North Shore, Northwest region. They can't maintain the upkeep, and because they're of an age where they demand a lot of work to them. People are just too old, too fragile, too sick to climb up on a second story to clean the gutters. On the ladder to clean the gutters and so forth. Well, they've got to go. But where do they go? One of the sectors of this industry that hasn't gone down in value is the retirement villages and retirement homes. In actual fact, they've gone up in value. And if they want to retire, they're looking at the bottom line. So as Louis said earlier on, is if they're looking at the bottom line and they're thinking to themselves, hold on a minute, if I'm going to get $2 million, but I can hold on another year or 2 years and wait and see, I might as well wait and see, because my $2 million isn't going to be buying me much close to the area that I grew up in, that I spent 30, 40, 50 years of my life in, and now I want to retire. What's their other choice, Martin? Is to go out 30, 40, 50 kilometres further out. They don't want to do that. So, we've got an absolute mess there, because there's just no accommodation for new families, for the retirees, for the new migrants that are coming in, for people that are migrating from regional areas back into the city areas. There's just no accommodation. So you can't even rent to say, I'm going to sell and rent for a year. What do you rent? A caravan in a caravan park down the Shire? Where do you go?
Probably a tent somewhere. But it makes the point, doesn't it, that the story about supply is it's probably going to be limited for quite some time. But we're not seeing at the moment forced sales really coming through in any great quantum, right? And that's interesting observation. The question is, how long will that be sustained? Lou, what's your perspective? Do you think we're actually going to be seeing a bit of an inflection point later in the year as interest rates continue to sort of go up and people are sort of hanging on? Will they be able to hang on? What's your sense?
Yeah, well, I think you raise an important point here. One of the reasons why this is more of an orderly downturn, we've talked about the listings, is that we're just not seeing a lot of forced sales in the marketplace. So despite the rate rises, so far most property owners have been able to hang on. We haven't entered into any type of panicked selling period. Now that's not to say we won't. If the RBA gets too aggressive and we have a hard landing in the economy, we'll get a lot more forced sales. And it's fair to say that, look, we have seen an upward trend in distressed listings, and I might just share something with you once again on this point. So what I'm sharing here is accounts of distressed listings for New South Wales, and we run through the other states here. So, we did have a pickup here in 2002, but we're still well below where we were pre-COVID. This period here was a very abnormal period. This is a time when we had aggressive interest rate cuts, as we know, cash rate brought down to 0.1% and fixed lending rates in the ones. And also a time when the banks essentially offered moratoriums to any distressed property owners who were struggling to pay their mortgage. So there were these moratorium periods. So we've finished it with that period now. We've had rate rises. Are the banks doing more repossessions? Look, I think they're still being a bit cautious. I think we've passed a period of the moratorium stage. But I overall, I think the indication I get from the people who look after lending books is that their customers are holding on. They're just holding on. And when we released our forecast for last year for this year, we did a survey of these lending book managers, and generally the view was, hey, my customers are holding on now, but I wouldn't want to see a cash rate over 4%. That was generally the consensus. And so this is where we're getting up to with the RBA. Where are they going to go with the interest rate? Because I definitely can see a situation where they get too aggressive, then we're going to have a steep rise in distressed selling activity, in my view. So it's in the hands of the RBA at this point in time. But yeah, there is, we only have to look at the rental market to note that, look, we're not seeing a great deal of surplus properties out there in the market. And I think this is where, we consider some of the great crashes that we've had in the past worldwide, the US housing crash of 2008, at the same time, of course, the great crash in Ireland that occurred, and of course, the big housing crash in the early 90s in Japan. One thing that was the case for all three of those big market crashes was a massive surplus of rental stock in the marketplace. So there was so much building that it swamped the rental market, and it was one of the key reasons why there were some big price falls in those three crashes. And as we're well aware, and we can bring up the charts, but I probably don't need to because it's regarded as being fact that we've got a very tight rental market still.
Yeah. And just on that rental market, one of the things I see from my surveys is that a number of property investors have actually left the field in the last few months, right? The logic is I'm not getting any capital appreciation in my property investment. The gross rental return isn't flash, but the net rental return with higher interest rates is pretty appalling. and I want to lock in some of that capital appreciation that I got through that 20 to 30% run up that we saw thanks to the COVID stimulatory programs that with low interest rates and everything else. So the stock of property investments is actually dropping at a time when we've actually opened up the spigot to bring more migrants into the economy. So there's a really concerning issue here where the dynamics are that the rental sector is really squeezed at a time, as we're saying now, when property listings are down. There are so many tension points, I think, in the market.
Yeah, and to add to your points there, Martin,
Yep.
to add to your point there is a lot of investors or agents that are holding on to these property managements that are holding on to these properties. A lot of them are telling us that their landlords just are almost to the point where they can't afford to keep the property, albeit the mortgages may only be a 30, 40, 50% LVR, and the rents aren't covering it, but it's the maintenance on top of that that becomes even a greater issue. That's really that's not spoken about, and the construction costs and the renovation costs, and the even if you want to renovate or build something extra on your property. We've gone from, as we've shared before in our podcast, we've gone to per unit or per lot basis, or when you're building an apartment in Sydney, from 360 with a second tier, first tier type of more of a second tier builder, to now, that was pre-COVID, to now costing 520 per lot, per unit, when you incorporate all the common areas and basements and everything else. So where do you go? There's no construction. More people are coming in, and this is what's keeping that. Given it that soft landing. Now, remember, there was, Louis, you had a discussion with Ross Greenwood a couple of months ago, and you got berated over it, and you and Ross spoke about these economic factors that we're in now, and this is what's basically cushioning these massive drops. Now, going back to the other point that you guys brought out earlier on, with regards to mortgage stress. I mean, a lot of people still don't get this whole thing of the difference or the timeline between mortgage stress to mortgage delinquency and mortgagee in possession. That could be 2 to 3, 4, potentially 5 years. So there's a long lag between it. To Louis' point, yes, there is a lot of mortgage stress. We said it only a week or two ago. We were talking about mortgage stress, the high levels of mortgage stress, with your high net worth individuals to your everyday Joe out there in the on the streets. There's a lot of mortgage stress, but where do they go, Martin? This is the big question. Where do they go if they sell? Where do they go? We know that they're getting rid of the toys. We know that they're getting rid of all the ancillary stuff that they built around them. We know that children are going from private back to public schools. We know all this, and in your higher brackets, the mistresses have to go, obviously. So in order to maintain the principal places of residence. Lou will know a lot about that. He lives in the eastern suburbs. So you've got to get rid of all these toys. So all these ancillary stuff is going. So, we jokingly talk about doing a survey on garage sales.
Yes.
I look closely at Tarex and other people from Canada, the used car sale index. Yep. Because that tells you the pain that people are going through, not only the used car sales, but also the speedboats, the extra boats, all the toys, as I refer to them as being. And all those are going to go in order to maintain a lifestyle that they've been used to, whether they've been used to 2 or 3 years. In relation to delinquency and going into receivership, I see more of that in your areas where there's no real infrastructure. I see more of that in your areas where first home buyers were duped into buying, such as your Marsden Parks, your Schofields, your subdivisions down here at Ingleburn, where all the outskirts, where there's real no choice, where they were never really worth $950,000 in the first place when they first came on the market 2 years ago, 3 years ago. That's where you're going to have a lot of pain. Potentially, that's where you're going to see it. See all this huge deluge of people just walking away. You could say literally handing the key back to the bank, although they won't be able to. But whereas in your established areas, I don't see it. I really just don't see it. Not just yet.
I think
Not
the
just
yet.
yet.
I think the yet's the key point there, Edwin. And just going back to you, Louis, and the data there, I think it's very telling that, the listings, although they're up a little, they're probably going to drift quite a lot lower. And I guess the question then is, if that's true, is that going to put a floor under how low home prices are going to go? Because, Christopher Joy's come out and said he thinks there's going to be a further significant fall. And of course, the market's been spruiking a recovery. And in fact, I've seen in the over the weekend, people say, "Oh, look, the falls were low. It looks as though it's turning." Is that hopium, Louis? What do you think?
Martin, I think it's very much in the hands of the Reserve Bank of Australia. As mentioned before, we think a cash rate of circa 4%, and you start to see pain to the point where we could see more forced selling activity occur, and potentially a rise in listings because property owners have had it, and the banks have quietly said to them, "You need to sell, otherwise we're going to do something about this situation." So it is in the hands of the RBA in many respects, and what's come out in recent days is most interesting. The private meeting with Barrenjoey certainly hasn't gone down well. We've many pundits. It's understandable why it hasn't gone down well, because we can see that the market there was a market move on this meeting, which wasn't shared widely.
Yep.
But nevertheless, it seems like what was shared in that meeting was some guidance which would suggest that the RBA is not pausing anytime soon. And so, if that is indeed the case, that they're going to keep lifting rates for longer and they're not about to go on pause, then we're the odds of a hard landing, a real hard landing in the housing market, as well as a wider hard landing in the economy, start to rise significantly in our view. So where we came out, just to repeat, we came out and we said our base case scenario for 2023 was that the RBA would need to pause, would pause, that the information we understood about what was going on in the mortgage market, they would know this as well. And therefore, they, in terms of trying to, hold this balancing act to try and engineer a soft landing, they would pause at some point below a cash rate of 4%. With this information that's come through, they seem to be suddenly quite more concerned about inflation, to the point where it's sounding like we're definitely going to get a rate rise next month. That takes us, of course, to assuming 25 basis points, 3.6%. And they mentioned in their statement rises, so we can assume at least 2. So then we go from 3.6 plus another 25 to essentially, what's that, 3.95, right on the threshold of where we think this is where the market will no longer be able to take. So if they go beyond that, then we will be very public. The fact that means that one of our other scenarios, which is a far more bearish scenario, is very likely to play out. And then, Chris Joy's general long-term view of this whole cycle may well just play out after all.
Absolutely. Well, it's interesting because after Phil Lowe's outing last week, the markets have priced in considerably higher. So we're above 4% peaks now, whereas they'd actually been well below 4%.
That's right. They were, the money markets were forecasting a peak and a cash rate as low as at 1.3.6 just only, a couple of weeks ago.
I know, exactly. So it's big moves. And I think it's very important to underscore what you just said. Rises, right? That was the language that was in Phil Lowe's statement. Now, those words are not just sort of plucked out of the air, are they? They're carefully crafted. So there's a very important signal there that rises, multiple interest rate rises from this point must be expected. And that's really what I think has shaken quite a few people. And that's, of course, then why people started questioning his judgment and all of those things. But the key point, of course, is, and all central banks are wrestling with this, the inflation genie is out the bottle and it's not really getting under control. So that's the reason why they're doing what they're doing.
Bring in the UFOs.
They'll bring in the UFOs, exactly.
That's it, Lou. We bring in the UFOs, the next level of control. Keep the listing numbers down because that is key, right? And then you've got a stall, and then we've got a stalemate, so nothing moves.
Well, that might be a little bit fanciful about the UFOs. Although we did produce it last week, we must say we did talk about UFOs. But Louis, you run these different scenarios. And I know that you were relatively confident about that the RBA was going to sort of, ease back a little bit. I have to say that I'm not confident now at all about what's ahead, other than higher interest rates, a squeeze on listings, probably more distressed sales, and therefore property prices probably continuing to move down, not uniformly, units versus houses, different locations. But the idea of seeing anything like another 20% rise like we saw through COVID is completely off the agenda, isn't it?
Oh, right now, that's absolutely right. Now, if the RBA were to pause after all, say we do pause below a 4% cash rate, we're still confident that we would see a bottom in the housing market this year and a recovery start to take shape in the second half of the year. Why do we say that? Well, we know historically that there's been a strong relationship between inflation and housing prices for some time. In the 1970s, for example, in Sydney, we had an inflation rate which peaked at one point, I think it was like 1975, we had 17.5% inflation. That same decade, Sydney housing prices quadrupled. They quadrupled in nominal terms, in just one decade. And Melbourne tripled. And there is a relationship there. And when you think about that, makes sense, right? Okay, when you have fiat currency starting to really devalue, people want to have protection. They go to tangible assets, things which are real, as much as they possibly can to hold some type of wealth against a situation where the local currency is devaluing, at over, say, 10% per annum. So there is that relationship there. And look, hey, you can argue that on the rental side, we've seen strong inflation on rents. We know that asking rents have risen across the country in the last 12 months by over 20%. And that's, of course, lifted rental yields. So we're still confident that relationship holds, but it holds only to the point where the RBA keeps running negative real rates, negative real cash rates. And they still are, even with the rate rises, because we know inflation's picked up. But if they were to get to the point where they say, all right, we can't run negative real rates anymore because we know that means the inflation genie is still out there, we've got to run a positive real rate to truly get this thing under control. That's when you start seeing hard landings. So ultimately what we know is that means a real contraction in demand, aggregate demand, and that's a recession. That's what it is. We start to see a rise in unemployment, and when we get a rise in unemployment, that's a lot more borrowers who can no longer pay their mortgage and they have to sell. My argument is that up until a point now, since we've had a rise in incomes in nominal terms, and I note nominal GDP, as per reported by the ABS, is up by 13% for the last 12 months, okay, that there has been some offset there to keep the borrowers still in play, to keep the borrowers holding on. They still have their job. Most likely, many of them have had a pay rise, a good pay rise in the last 12 months, okay? And so they're still able to hold on. They've been squeezed, no question, but so far they can hold on. And in this country, above all, property, their home, their principal place of residence is the last thing that goes. It just is. It's different from the States in that sense. Property in this country, you lose your property, you have to sell your property. My goodness, that's massive social and reputational damage to you personally, something you would never want to tell your friends about. It's the very last thing that goes. But if the RBA is aggressive enough, if they do decide to run positive real rates, it very well can still happen.
Absolutely. Well, I want to say thank you both to you for sharing your thoughts, and I think it's been really interesting just getting this integrated view. And I guess I would summarise it as saying there's quite a lot of uncertainty in the markets. Clearly, what the RBA does is going to be very significant. But as Edwin said earlier on, those other actors and how they actually influence the markets is also worth bearing in mind. And finally, I'd also highlight the political ambience around this. We've got an election in New South Wales in the next month or so. We're going to see some funnies coming out of that, I suspect. So this will be a really interesting time to watch the property market. Louis, before we go, if people want to find more about your research, where do they go?
Oh, sure. Just come on our site, sqmresearch.com.au. And as you guys know, we've got a lot of free property data there. And we've got paid reports there where they can get valuations and a whole bunch of other things we've got in there as well. We cover the equities market and we cover managed funds.
Terrific. And Edwin, thanks also to your insights too. And we'll be having more chats down the road as this property market juggernaut heads off who knows where. Thanks very much.
Thank you.
Thank you, man.